Have you ever found yourself wishing, maybe, for a crystal ball when it comes to the markets? Imagining you could spot the next big move in stocks or crypto or Forex before anyone else. Well, today we're not just looking at a crystal ball, we're kind of building the lens for one. We're going to cut through the noise and reveal the real algorithms that professional traders, quant developers, are using right now to forecast prices. So, our mission on this deep dive is really to unpack the journey of algorithmic market prediction. We'll trace the evolution from, those foundational statistical models all the way up to the cutting edge stuff, deep learning, hybrid systems. We're talking about understanding which approaches, well, which ones actually gain traction in the real world and what common pitfalls trip up even seasoned quants. And crucially, how you can actually get started with concrete tools and platforms.
Yeah, what's really illuminating, I think, is that our insights today aren't just theoretical concepts. They're distilled from a pretty rich blend of sources: academic research, industry white papers, practical professional blogs, and real-world case studies, too. The goal really is for you listening to walk away with a genuine grasp of the how, but maybe more importantly, the why behind successful market prediction.
And trust me, the way these models have progressed, it's quite a story in itself. We're going from the time-tested statistical workhorses to these really complex neural networks that can learn from just vast streams of data, and even hybrid systems that adapt as market conditions change. So by the end of this deep dive, you should have a clearer roadmap to begin crafting your own sophisticated prediction engine. Okay, so if you're just dipping your toes into algorithmic trading, a really common starting point, often for good reason, is with the classics, right? Statistical time series models, think of them as the foundational building blocks. Two absolute workhorses in this category are ARIMA, that's autoregressive integrated moving average, and GRRC, generalized autoregressive conditional heteroscedasticity. ARIMA models, well, in essence, they try to predict future prices based on a mix of their own past values and past prediction errors. So they're effectively capturing, short-term trends or maybe how prices might revert back to some mean value.
Precisely. And GRCH, on the other hand, is absolutely crucial because it doesn't just model the price level. It models the volatility itself. It allows the variance, the sort of market nervousness, to be dynamic. Right. This is incredibly important when markets swing wildly, maybe during major news events like earnings announcements or, sudden geopolitical shifts. And in practice, these models are pretty straightforward to implement. You can use Python libraries like stats models. They offer quick baselines and critically interpretable outputs. You can actually see why the model made a certain prediction.
Right, interpretability is a big plus there. But here's where it gets, well, more complicated. While they're powerful for certain patterns, ARIMA and GARCH can really struggle with the kind of subtle, nonlinear relationships that frankly dominate real-world market movements. They also typically require the data to be stationary, which means its statistical properties, like the mean and variance, don't change over time. In real-world price series, they're notoriously non-stationary. They trend, they fluctuate like mad, their volatility shifts all the time. So you often have to do significant data pre-processing, things like differencing, just to make the models fit. And even then, you're kind of fighting an uphill battle against the inherent nature of markets.
That's a key limitation, definitely. It's exactly why practitioners pretty quickly embraced machine learning. ML models are just designed differently. They're built to capture those elusive, nonlinear relationships without needing all those rigid assumptions of classical statistics. We're talking about techniques like ridge or lasso regression, which basically extend simple linear models but add regularization. That's essentially a clever way to prevent the model from getting too specific to your training data, overfitting to noise. Then you have things like support vector machines, SVMs. They can be quite good at separating, say, up days from down days by finding an optimal dividing line or even a complex boundary between different types of market movements.
Yeah, and for even more complexity, maybe more predictive power, ensemble methods like random forest and gradient boosting machines, think XGBoost, they truly excel. They can learn incredibly intricate interactions between a whole multitude of indicators, whether that's traditional stuff like moving averages, RSI, MECD, or even alternative data like market sentiment scores scraped from news or social media. I remember seeing one comparative analysis where XGBoost actually outperformed both traditional ARIMA and even some deep learning LSTMs when predicting, I think it's Google's stock close price. And that wasn't just a fluke. It really highlighted XGBoost's power in harnessing meaningful patterns across potentially hundreds of diverse features, which is, a critical insight for modern trading.
Absolutely. But the real, I'd say, revolution over the past 5, maybe 10 years has come with deep learning, particularly recurrent neural networks or RNNs, and maybe their more famous variant, long short-term memory, or LSTM networks. LSTMs are specifically designed to process sequences of time-ordered data, like a long stream of prices, which is exactly what we have in finance. They're quite adept at remembering which past time steps, even distant ones, are most relevant for forecasting the next price. They've shown significant promise in backtests and in some live trading scenarios too, especially when you combine them with powerful add-ons like attention layers, which basically help the model focus on the most important parts of the input data. Or maybe bidirectional architectures that let the model look at patterns both backward and forward in time.
Right. And in controlled studies comparing these different approaches, ARIMA versus RNNs, LSTMs, and even the newer transformer-based models that are getting a lot of attention. LSTMs have generally achieved lower prediction errors on out-of-sample tests, though it's definitely worth noting that transformers are rapidly closing that gap, and in some cases they're even surpassing LSTMs because they excel at capturing very long-range dependencies and sequences, which could be crucial for identifying those big overarching market trends.
Okay, so this brings us to a really crucial challenge. How do we make these sophisticated models, more robust, especially when market dynamics are constantly shifting? Because what's often overlooked is that markets aren't static. They cycle through different regimes. Maybe you have a calm bull market for a while, then a really volatile bear market, or even just a period where prices chop sideways. And that's where hybrid models become incredibly powerful. What's fascinating here is combining, say, hidden Markov models, or HMMs, with neural networks. HMMs can be really effective at detecting these hidden market regimes, basically identifying the underlying mood of the market. You can then use that detected regime to condition how your deep network makes its forecast, adapting its strategy on the fly.
That's a really powerful approach, isn't it? Because it explicitly recognizes that the rules of the game can change. I saw a recent study, I think it was in the energy sector, that demonstrated how integrating HMMs with neural networks achieved a pretty significant return over a volatile period, had a solid Sharpe ratio too. Now, those specific numbers are impressive, sure, but the real takeaway isn't just the raw return, it's the lesson, right? It's that by understanding when the market is in a specific mood or regime, your model can adapt its predictions accordingly. This kind of two-stage approach helps the model remain robust even when market dynamics shift abruptly, like when a central bank makes a surprise announcement and triggers a complete change in market character.
Well, of course, yeah. No discussion of forecasting algorithms is really complete without addressing the elephant in the room. Data snooping and overfitting. This is where so many new practitioners, and honestly, even some experienced ones, can stumble pretty badly. You might try hundreds of different indicators, tirelessly tune hyperparameters on your model, and then you marvel at these spectacular backtest equity curves, only to see live performance completely collapse. That's classic data snooping bias. You've accidentally fit your model to the noise and the specific quirks of your historical data, not to any true underlying repeatable pattern.
Right. So, what does this all mean for avoiding those common pitfalls? How do you guard against fooling yourself? Well, professionals live by a few core principles here. You absolutely must use rigorous testing techniques like walk-forward analysis or nested cross-validation. And always control the number of free parameters, the complexity you're allowing the model to learn. Keep it simpler if you can. Some even apply more advanced statistical tests, like White's reality check, just to guard against finding spurious results purely by chance. The hard truth is, a strategy that looks amazing on historical data might simply be a lucky fluke. And a true deep dive practitioner needs to be incredibly skeptical and guard against that.
Definitely. And implementing these algorithms, well, it requires reliable data pipelines, robust backtesting frameworks, and eventually, if you go live, low latency execution. The Python ecosystem, it has really become the undisputed champion for many quants. You'll heavily use libraries like pandas and NumPy for data manipulation. That's fundamental. Then maybe taillib for calculating technical indicators, scikit-learn for your classic machine learning models, and TensorFlow or PyTorch for the deep learning side. And for backtesting, which is absolutely critical, tools like Backtrader or perhaps the older Zipline are essential.
And when you outgrow your local setup, maybe you need more computational horsepower or integrated data sources. Cloud platforms like QuantConnect offer a really unified environment. They provide a single API for research, backtesting, and even live trading across equities, futures, Forex, crypto, the whole range. They're powered by their open source Lean engine. They support both Python and C#, which is nice. And they even integrate alternative data sources, allowing you to easily test things like sentiment indicators or macroeconomic factors alongside price data.
So for anyone starting out, our advice is almost always begin small, really small. Pick one asset, maybe one simple algorithm like ARIMA, and keep your feature set absolutely minimal to start. Build a basic ARIMA forecast just to set a performance baseline. something to compare against. Then, perhaps implement something like a random forest, using just a handful of well-understood technical indicators, like a couple of moving averages and maybe RSI. Track your key performance metrics, chart pay ratio, maximum drawdown, out-of-sample error really rigorously. Only after you've solidified that basic pipeline and gained some real intuition for how it behaves should you think about graduating to more complex, deep networks or fancy ensemble strategies. This gradual approach prevents you from drowning in complexity early on and truly helps you understand what's actually driving your model's predictions, or lack thereof.
Okay, now, when we talk about applying these models to different markets, things get pretty fascinating. Take crypto and Forex. For instance, these markets trade 24/7, often less centralized structure compared to equities. The extreme volatility you often see in crypto, well, it can be both a blessing and a curse for predictive models, can it? On one hand, high volatility might amplify real signals, making them easier to spot, perhaps. But on the other hand, it can significantly magnify the noise, making true patterns much harder to discern reliably.
That's spot on. For crypto specifically, approaches like Profit, which is a decomposable time series model originally developed by Facebook, or even LSTM ensembles trained on really high frequency, maybe minute level data. Those can be incredibly effective at uncovering recurring intraday patterns, like patterns related to exchange opening hours or specific trading sessions. Now, for Forex pairs, a different dynamic often plays out. Mean reversion tends to be, generally speaking, more reliable than trying to chase pure momentum trends. So you'll often see simpler models, maybe like Ornstein-Uhlenbeck regressions, which explicitly model mean reversion, or even low-feature SVMs, hold up surprisingly well, especially for currency pairs that tend to oscillate around some central value over time.
Interesting. And before we wrap up, it's probably worth briefly touching on reinforcement learning, RL, because this is a very different paradigm from supervised forecasting. RL treats trading as a sequential decision-making problem. You have an agent that learns to maximize some cumulative reward, like profit, through taking actions buy, sell, or hold over time. People have applied things like deep Q networks, policy gradients, actor-critic architectures, with, let's say, mixed but definitely intriguing success so far. In simulated environments, where transaction costs are zero and slippage doesn't exist, RL agents can indeed learn incredibly novel and sometimes really counterintuitive strategies.
Right. And what's fascinating here, sort of tying it all together, is realizing that no single algorithm just reigns supreme. There's no silver bullet. Classical models like ARIMA and GRCH, they remain invaluable, especially for establishing baselines and interpreting some of the fundamental market dynamics. Machine learning and deep learning, on the other hand, those are really the powerhouses for unlocking complex nonlinear relationships hidden in the data, often at scale. And then hybrid models, particularly those using regime switching frameworks like we discussed, they offer crucial robustness when market characteristics inevitably change.
So what does all of this mean for you, the listener? Well, we've seen that discipline is absolutely paramount. You really must control for data snooping bias. You need to build your systems incrementally, starting simple, and rigorously validate everything out of sample. The essential tools we covered are kind of your bedrock. Those Python libraries like Pandas, NumPy, Talib, scikit-learn, TensorFlow, or PyTorch for the heavy lifting. Robust backtesting tools like Backtrader or Zipline are non-negotiable, and potentially powerful cloud platforms like QuantConnect can really accelerate your entire workflow from research to deployment.
Yeah, and if we connect this back to the bigger picture, just remember how strategies often need to adapt across different asset classes. For crypto, that extreme volatility amplifies both the signal and the noise, demanding models that can somehow handle that dual nature. Whereas for Forex, the general prevalence of mean reversion often means that simpler, perhaps more robust models can prove surprisingly effective.
Okay, so this raises, I think, an important question as we look towards the future. We touched on reinforcement learning as a potential next frontier, right? Where these agents learn to maximize rewards through direct actions like buy, sell, hold. Now, if these agents can learn genuinely novel, maybe even superior strategies and simulations, how do we begin to overcome the real-world frictions? Things like unexpected market shocks, liquidity drying up suddenly, or just changes in market microstructure, the stuff that currently causes them to struggle with generalization when you try to put them into live trading. What will it truly take for RL to break through and become a consistent, profitable force in real-world algorithmic trading? Something to think about. Well, we certainly hope this deep dive gives you a clearer roadmap to explore the vast and sometimes complex landscape of algorithmic prediction methods for equities, crypto, and Forex. Happy coding, and may your algorithms be ever in your favor.